All right, there we go. Should be looking good now. Let me know down below if you can hear me coming through loud and clear, but everything appears to be doing fine. It was having some kind of issue recognizing my streaming software. But that being said, it looks good, so let's go ahead and jump on in. Welcome back to the channel, Crypto Trend Trader with our midweek market update. It is 8 p.m. Eastern Standard Time on May 18th, 2022. Before we get started, just a reminder, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, so let's jump right in and take a look at some charts. So obviously, more excitement in the market never ceases to amaze us, or at least to amuse us, one way or the other. So just starting with TNX, we see that weakness is continuing as expected. We printed some bearish divergence from our most recent peaks. We now came up and put in a lower high as well. So we would expect this to roll back over. We're currently at support at the 21 on the daily. Still has ways to go down. We discussed some of those targets in the last stream. But basically looking for somewhere in between our previous high and the 200 exponential and simple moving average. We could see something as aggressive as, a pullback to 2.0. Still have to wait and see. We'll have to wait and see how deep it goes. We haven't even crossed 821 to the downside yet. It could bounce here and continue to the upside. We haven't even seen the slope on the TJD, TDMACD flip red yet. And the last time we did, it flipped red, and then we immediately saved price action. So we don't want to get too bearish on this for right now. We know obviously that a lot of this is fear driven currently, and I don't expect that to change. So, and then the 210 spread. So we basically have the 10-year is at 2.884 and the 2-year at 2.667. Again, just kind of like trending towards each other, still a little bit apart, but we are seeing a hard sell signal. We're still inside of the bullish control zone for now on the weekly. But we are very, very close to violating that area. So we're at, well, not very close. We're at like 91 right now. And obviously transition is at 80. So a little more rolling over. And this is going to start looking a lot more like this is probably the peak in the cycle. But again, we'll have to see because we see obviously the 2-year bounced that resistance / support line. So it's finding support and then actually like they're converging on each other slightly. So we'll see what happens. On the weekly right now, though, we're seeing some weakness. We're seeing a hard sell signal. Would not be unrealistic to think we get one more push up, though. So TLT had broken down from that key channel support line, and now we're just retesting it as resistance. Tried to get back above it once and then rolled over. Second time we're back at it now, and that's where it closed. I really do want to see this area reclaimed. We do have bullish divergence printing from the previous 2 peaks right here. You guys know I favor, obviously, like 3 drives of divergence, as that's typically when we see like the divergence play out. But a lot of times it will happen on, just 2 points. So we don't want to, overlook this as a potential bottom, but a 3rd drive of divergence between, these 3 peaks would look much more realistic, much more likely. And then again, we'll keep watching this on the weekly and see what it looks like towards the end of the week. So U.S. oil came back up to resistance. This is the area we've been watching. Nothing has changed as far as I'm concerned. We have been watching the resistance in white. We failed to take it out. We just put in a lower high. So it's slightly below the previous high right here. So nothing has really changed as far as I'm concerned. Because we still have a high, then we have a low, then we have a lower high, then we have that same low again, then we have a lower high once again. Now, arguably, you could just say at this point in time, or as I've said previously, if we just, I thought we did it last time, maybe not. If we just extend out the bottom of the triangle, in my opinion, or, in actuality, we had a blow off top right here, throw over, failed breakout, whatever, that's a V top, obviously. And now here we're putting in just a high, then a low, and we're doing it at this horizontal support. And now here's that horizontal resistance. So we're just range bound. We're just trading inside a channel. So realistically, what we should do is we should get rid of these 2 points of interest, and then we can at least get a heart line in there too, and it'll keep us focused on those levels as well. So we're just going to take the close from C once again, and we're just going to put it out just horizontally, and then again on the bottom of the range as well. And we can just actually extend it just slightly beyond that, so we can encompass both of these. Now, because we use the close on the top, and that's the area we were watching, it makes sense to use the close on the bottom. You know, if you're using wicks, you should always use wicks. If you're using closes, you should always use closes. Just try to be consistent. Not necessarily with whether you use wicks or closes. That's up to you completely, because people chart different ways, and that's fine. But if you're going to use a close one area, like the top, you should use close on the bottom as well and be consistent in that way. And you can even try using just the wicks and then see how it looks versus just the closes, etc. But in this case, because we're looking for a technical breakout, I'd rather use the closes. So again, we're just at the top of the range now. We're starting to lose some strength here, starting to roll over a little bit. No surprises here. We're at that key fib level now. It didn't quite hold. We have the 21 moving average still below us. We have the heart line below us. We have another Fibonacci below us, and then we have the bottom of the channel. So, I would expect us to just continue oscillating inside this range. Still just holding between 95 and, roughly like that 114 mark. Until something changes, my outlook doesn't change at all. In my opinion, though, the longer this just goes sideways and consolidates here, the better it's going to probably look on longer time frames. But, at some point in time, we'll figure out, is this distribution or, reaccumulation before we go higher? My bet would be that it's distribution. This was a long, big trade that everybody piled into. This isn't enough selling pressure at the top right here to get everybody that wants to get out of this trade. So it makes sense you see distribution take place, and then we break down from that level. Now, of course, like I said, it does not have to be the case. We could easily break up from here. And I am long-term bullish, but I do think that we're going to see a cooling off period. All right, so looking at Dow Jones, so we got that next move down, as we've been discussing. Obviously was a very, very aggressive selling candle. Once again, just trapping the last, 4 days or so worth of people who tried to buy the dip. No surprises here. We're clearly in a bear market. We've broken below the 200 exponential and simple. They're both angled to the downside. The slopes, obviously, red and pink. The 8 and 21 have crossed to the downside. We could not reclaim those levels, and we're just consistently putting in lower lows. So we talked about it on our last couple streams. I was joking around about the sign, the how many days since last incident sign. Well, if the last incident is the lowest low of the cycle, I would say, reset it again. So we made it to 3 days without a new low in the Dow Jones. Congratulations. Now everybody gets bullish when we have 3 days. Come on, who are these idiots? I mean, obviously we're intelligent enough to know that as long as we're consistently putting in lower lows, we're not going to try to pick the low, because every 3 days you're wrong. So that's, you're like, oh, I'm 3 days from finding out if I'm wrong or not. Oh, wrong again. Lost my money. Let's do it all over again. Sure, that sounds like really sustainable. So we see, obviously still have, 2 days, Thursday and Friday of this week. But again, we're, putting in lower lows on the weekly consistently, week after week after week. This is our longest sustained downtrend we have had in some time. What is this? We're on our 8th week right now of bear momentum. 8th week of, just selling off. We saw nothing like that in the Rona dump. We saw nothing like that in the previous highs. We really have not seen any weakness like that, even close, on any of these previous sell-offs, until we get back to the big one. And even here, we don't even see that many. We get 1 day of green, or 1 week rather of green. So this is definitely one of the most, just brutal, consistent selling streaks that we have seen for a while. Yeah, even through here. I mean, that's wild. That's all the way back to 2000, before the dot-com bubble burst. That was the closest we saw to like 7 days in a row of 7 weeks, in a row of just straight selling. So obviously brutal. Headed down to our target. No surprises here. We are still looking for the target of the 200 exponential and simple, right around like 29 and some change. And then also that was the previous high from the Rona dump. If we turn on our drawing tool, we could see we have our Fibonacci from the bottom right here all the way up to our top right here. And then we know that corresponding with that previous high, we have the red resistance, or in this case, potential support, and then 200 exponential and simple. And then that also lines up with some of our other key areas as well. So that would be, we're right at the 236, which we already tagged. The 382 is slightly below that at about 28,000. But I think we'll see at least a pit stop at around like 29,400 or 500, somewhere around there. But still, again, just seeing a lot of weakness, a lot of weakness. You know, I know everybody wanted to get bullish because we saw some actual strength on Friday, but, you know, it's just all gone now. It's all bled out, as expected, as expected. So SPY, the old spider, clearly in a bear market. We're below the 200 exponential and simple. They have rolled over. We have an extremely, extremely bearish candle. Again, we had, you know, 4 up days right here, and we completely wiped those out. We did not put in, I shouldn't say completely, because we didn't technically completely. Every time the S&P has remained stronger on each of these sell-offs. Here we put in that low, and then we actually put in a higher low, and then went higher from there. Here we put in a low. We technically still have a higher low right here. So for now, it's not as bearish as our other indexes, or at least the Dow Jones. But then when we switch over again here to the week, and we don't know what's going to happen the next couple of days, probably new lows. You know, we probably wipe out that daily. But again, we see just consistent new lows on the weekly. And again, we're in our 7th week, down week so far. Still 2 days left. Who knows? Maybe we rocket to the upside and close bullish, but I doubt it. I don't see anything that tells me that. And again, we're very close to our target. Now, we don't have the same confluence with the SPY as we see on the Dow Jones on the weekly. But again, we have our fib here at the bottom. Man, there's a lot of stuff going on in this chart. Maybe we could get rid of this. It's kind of old. We don't need that one anymore. Yeah, that'd be all right. So yeah, we have our fib down here at the bottom, and then we just have that going to the top here. Now see, we have our top right here. That comes in between the 382 and the 0.5. It doesn't quite line up with the 200 exponential or simple in the same way that we see on the Dow. So we have our previous peak right here. We have the 382, the 200, and the 200 simple all around the same areas. So technically, our target for the S&P is a little bit more like kind of muddled. You know, we could see it basically stop at the 200 exponential. That's possible. I don't think it's likely. I think it's much more likely that we see something like this, where we actually come down between the 382, the 200 simple, and that previous high from the pre-Rona dump. So that's the area I'm watching for. Let's extend this out a little bit so it's not as, there we go. So that's the area I'm looking for. Basically watching, you know, right around like 340 to roughly 355. Would not be surprised, obviously, to see some, you know, bounces around that 200 exponential moving average. But it just doesn't hold up nearly the same way on traditional markets as it does with crypto. Again, no divergence. All right, and then the Nasdaq, again, holding up a little bit better than the Dow Jones, much more similar to the S&P. Still looks terrible, obviously. No divergence or anything showing up on the shorter time frames below 200 exponential and simple. Clearly still in a very bearish downtrend. Definitely seeing some weakness from the Nasdaq, but the last couple of days have remained slightly stronger. We do see the Nasdaq weekly has already touched the 200 exponential. So just in relation to what else we were looking at, we're already at targets to the downside. The next key areas to watch out for are obviously the 200 simple. And then again, we have that peak from the pre-Rona dump. So we have our 200 exponential we already tagged, the 382 we already tagged. Next target would be the 200 simple or the 0.5, and then slightly below that. So, you know, we see all these levels of confluence. Some are lining up perfectly. Others are slightly off one way or the other, a little more bearish, a little more bullish. And then, you know, obviously we have relation to the 200 weekly moving averages, and then also the pre-Rona dump high. So when we look at all that together, the fibs, the moving averages, and the previous top, it's important we look at all these. While I'm not necessarily looking for a macro bottom right now, I'm definitely looking for a tradable bottom on some of these major indexes. Not necessarily even to trade that index in specific, but because I think we'll see a broader market rally after we do hit some of those key levels. But the thing is the weakest ones that get to those levels first. Like if one is already at the 0.5 and everybody else is at the 382, and you say, oh, the Nasdaq, for instance, which in this case it's not, but if we said the Nasdaq is already at the 0.5, so we should buy it here because that's probably going to be the bottom. But then everything else is still at the 382, and then they all have to get to the 0.5. Well, the Nasdaq's probably going to end up at the 618 by the time they all get to 0.5 because it's clearly, holding up the weakest or having overperformance to the downside. So we don't want to get too excited when one of these things hits our target. We want confluence between multiples, or we want to see some other indication, whether it's bullish divergence or some other rejection of lower prices, a candlestick pattern, something. Right now, we're seeing similarities between a lot of these, but the number one clearest picture is coming from the Dow Jones and those levels of confluence that we're seeing. And then we go to the Russell next. So the Russell has already tagged the 382, got a nice bounce. Again, put in a very bearish candle, but did not take out the low. So the Dow has been holding up the best, and now it's looking, the weakest. So does that mean that the market contagion is starting to, sort of widen out or broaden out, even into some of these big names? Well, obviously that's the case. And we'll talk about some recent moves that haven't changed the perspective for me necessarily, but I think that some of the earnings reports and forecasts of some of these specific companies, especially in the consumer staples front, definitely is scaring some of the Wall Street people a little bit, because I think they're very out of touch with reality. So they just keep saying consumer strong, consumer strong. Consumer debt is at the highest levels ever. So that's all bullish because the consumer is strong. That's why they're racking up all this debt and buying tons of stuff. But when you actually get down to it and you do the breakdowns and the math and everything, we're actually having a decrease in demand for goods. Consumers are just paying higher prices. So when it's all said and done, we're selling less goods for more money. So it looks like we're actually selling more goods if you just look at dollar amounts. But when you're not taking into account or adjusting for inflation, you're not getting realistic numbers. And obviously, we know statistics can be used to manipulate the data to make it say whatever you want it to say, and even in a reasonable way. And that's what we see is happening. But now with this recent, not only the earnings have come in and not been particularly bad, but the forward guidance from these companies or the outlooks going into the future is what really opens your eyes up. And then all of a sudden it reveals that consumers are paying more for less goods because of inflation. So they're spending more money, but they're getting less for it, obviously. They're making more money, but they're making less than their increases in cost of living. So their cost of living is degrading. So these are all obviously bad things. And then on top of that, the consumer sure is taking out more debt and, cash out refis from properties and record high credit card bills. But they're not doing it because they're confident going into the future the same way you are during an economic boom. They're doing it because they're trying to maintain their way of life, hoping that they can just grind out the difficulties ahead. But once these difficulties go from 1 year, 2 years, 3 years, 5 years, that's when we get that time capitulation, the most painful type of capitulation. Obviously if it's combined with time and price, but time capitulation is what really wears you down. So that being said, we'll look at those consumer staple charts a little bit later and talk a little bit more about that. But continuing on with the Russell. So we see here, obviously, weakness on the Russell. It has not only already hit, we're on the weekly. It has not only already hit the 200 exponential on the weekly, it has hit the 200 simple on the weekly and the 382. So it has hit all of our levels at the 382 level. So again, normally you would look at this as potential buying opportunity as we're hitting support. Unfortunately, the Russell is extremely, it's basically, one word. If we had to just sum it up, you guys know what that word is. It's trash. So obviously we're not looking to buy trash. We're looking for the trash to give us an indicator that something good and useful and that we would potentially want to own or invest in is bottoming. And so, the Russell is at these key levels, but it's also trash. So we're not looking to just buy up the Russell because it just raced everybody to the bottom and got there first. It's like, wow, great job. You're the biggest loser. Congratulations. You're at the finish line of garbage. You're the fastest piece of trash index there is. Great. So if we look back, though, also, we see the confluence levels. This was the peak from 2020 again, there's something else to show you how terrible and how much garbage the Russell is and why you probably would never want to invest in it. Obviously none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. I shouldn't have to tell you why not to invest in the Russell because it's obviously trash. You can do whatever you want. But if we look at the Russell in 2018 in August, it actually put in its peak, and this garbage, trash, horrible junk index didn't even take out that high before the Rona dump. So it was already extremely weak before it completely capitulated. So the fact that it just shot up here and then just continued to be just weak garbage trash and is now just melting down, it's not a surprise at all because it was trash back here in 2018. So now it's newer trash, but it's still trash, obviously. And no offense to anybody, it's not because I don't love America or the companies or the economy or anything. It has nothing to do with that. I'm just telling you the truth, and the chart's giving us the facts. So the facts are the Russell is trash. So you can be like, yeah, but it adjusts every so often and then they change out and then the good stocks will come in. Okay, well, why has it been trash since 2018 and then it was still trash in 2020 and only pumping trillions and trillions of dollars into the economy and creating the biggest, most speculative bubble likely of all time, was able to get the trash Russell to even get to a new high? Exactly my point. I agree. I rest my case. So anyway, we know the trash Russell has already hit all our targets to the downside. So we're not just going to immediately say, well, the trash has raced to the bottom and got there first. Let's buy it up. No, but we're looking at now, we're hitting some key levels on these things. So, and again, if we just flip back real quick to the Dow, just for a very clear comparison of what's taking place, I think it really, helps to show the Dow is just now hitting the 236. The Russell is at the 382. The Dow is still well above the 200 exponential and simple. The Russell has already blasted through all of them. The Russell's already at the 382 right here, and it has already hit the previous high from 2020. And then again, in comparison, here we put in a high on the Dow in 2018. Here we put in a higher high in 2020. So we can see the difference between if I was going to put $1 to work, and now you said you can only put it to work in two places. And I'd say, what are they? And please don't say AMC. And you said, for instance, Dow Jones and the Russell. Obviously, you would pick the Dow Jones. And I'm sure historically speaking, you could look back and there's probably a few periods where the Russell will outperform, but compared to the overall performance of the Dow Jones, it's going to be obviously pathetic. So that being said, the Russell is obviously telling us what we want to see here, hitting some targets, expecting it obviously to go lower, but already at some key levels. So again, we don't want to get overly, okay, I did switch that back. We don't want to get overly bearish on the other indexes as we're already seeing some of these targets get hit. But the Russell is actually hitting the most of our targets the fastest, which again just makes it the worst piece of trash. It's like the Luna of U.S. indexes. Maybe not that bad, but pretty close. We'll see when the zombies flush out. So next we have XLE. So we are watching XLE obviously very carefully. We were paying attention for a potential fourth drive of bearish divergence on this, as we had one drive here with a high, and then we had another drive with a higher high, lower drive, higher high, and then we saw a lower drive again with a higher high. Now here on the daily, we have taken out this previous low right here. So you say, well, that's it. The divergence is gone. It's over. Now what happens sometimes is you will get these little peaks in the middle here that you don't count as a peak. This one right here, let's say, for instance, it's clear that that wasn't a peak. We didn't even get 2 histograms in a row. That wasn't a top. So we're not counting that to invalidate potential fourth drive of bearish divergence. What we're looking at now, though, since we did take this one out, is could this possibly be part of this peak? Yeah, but it's pretty aggressive. So we don't want to rule out that the divergence is gone. But until we technically get above this previous high right here, this could also be just part of the move from the bottom to the top. So again, technically, until we get up here to like 1.48 on the XLE, we haven't actually printed, like invalidated that previous print of bearish divergence. So in all actuality, what it could be is we should be looking at just this drive, maybe this drive, who cares? It doesn't change anything one way or the other. Definitely this drive. So we have 2 clear drives of bearish divergence. Maybe this drive, but now it's invalidating, so maybe not. And then, probably this drive to see, because if this one goes higher, it's going to invalidate the bearish divergence because we already have a higher high in price. If it doesn't go higher, then we're going to see 1, 2, 3 drives of bearish divergence or 1, 2, 3, 4 drives of bearish divergence. However you're looking at it, doesn't matter. We're still looking at bearish divergence. And then again, we see the same thing here. Technically, this peak has already come up to the same level as this one. It hasn't surpassed it, but it's a very similar scenario because if we got a double top right here, but price went higher, it's still bearish divergence versus if the indicator goes higher and the price goes higher, it would invalidate it. But then again, we just look back at our last peak from bearish divergence and it's much, much higher at the 84. So again, we still have that potential bearish divergence developing on XLE. And again, this is a pretty aggressive single candle sell-off. Obviously, we had a little indecision here. We did hit the 2.618 finally, so that's good. I know I was being like kind of nitpicky about not quite touching it there. So we blew up above it now. We're back at the 8. We want to see what happens here. Do we consolidate and continue higher? Do we hold on to some of these key levels, or do we start to fall off here? Obviously, the 786 was a key level to maintain. You know, we're just under the 886 now. So it seems more likely to me that we push back up, continue to hit the 886, and then potentially top out there after seeing like a kind of stall and then support at the 786. But again, we'll pay close attention to it. We'll watch for any potential bearish divergence. I don't want to go short energy right now, but we're looking for that opportunity of a pullback so that we can re-enter, you know, for continuation. XTN next, transportation, obviously very weak. Again, it did not take out the low right here, but very bearish candle. Extreme weakness, obviously in a bear trend. You know, below the 200 exponential and simple, bull slope to the downside. We did come down on the weekly and tag the 200 exponential already. Our key level is basically the 200 simple and the 382, and then also the macro 236. So the green Fibonacci was from the lows, the run of lows, and then the macro goes way back. But once we broke down from this channel, and then we put in our bearish divergence peak right here, you guys know I've been very, very bearish on energy. And then also, you know, being one of the 4 horsemen of the apocalypse, tells us that the fact that this is topping out and showing so much weakness gives a strong argument or strong backing to the argument that we're getting ready to have a 2000/2008 type event, possibly even something as crazy as we saw in the 70s and 80s. But again, we're still a little bit off our you know, Rona highs. Again, we see the same thing though, where we put in a high in 2018. We tagged that high in 2018 again. We put in a lower high in 2020. So we know transportation was actually weakening. And then it was only that burst of economic stimulus, you know, and basically massive amount of demand with lack of supply that, you know, led this to new highs. So I would expect us to come back down slightly to around that 68.82 level, somewhere around there. We have 200 simple, we have the previous high, and then we also have the 382 and the 236 all right at this level. So again, this is going to be, you know, a very key level that we'll continue to watch. Very clearly trading inside a descending, broadening wedge, and very clearly just seeing constant weakness. We're now inside of the bearish control zone for the first time. Now, arguably last time that was the bottom. So you're like, oh, that's the bottom then. Bears are in control. It's the bottom. Probably not. Maybe. Probably not. You know, that's like the whole oversold thing. You guys know if you've been watching for any amount of time, I don't do like the whole like overbought and oversold thing, because the truth is things can get overbought and oversold for a really, really long time. And if you try to trade with overbought and oversold indicators, you're probably going to get wrecked. Now, if you're in a bull market and you're oversold, that's probably a buying indicator. If you're in a bear market and you're overbought, that's probably a selling indicator. Those are true, but you're also using those indicators counter the trend, and you're not taking the same from the with trend indicators. Like if we're in a massive bull run in Bitcoin and it says, you know, or let's just use XLF because that's what we're looking at right now. You know, for this period of time right here on the chart, we were arguably overbought or inside of the bullish control zone the whole entire run up here. You know, you see more than half the time the background is highlighted red. So we don't want to be selling. There was never a time when we really should have sold, arguably right here, you know, just to protect ourselves. But this was never bearish. Now, once we're inside of the bearish control zone and you're still in a bull trend, sure, that would be used as a buying opportunity. And we do actually put in higher highs since then. And then again, we have one more time it happens. But we're not using the bullish control zone as a sell indicator because it's with the trend. we're using the bearish control zone as a buy indicator because it's counter trend. So again, the same thing starts to happen here. Now we see that XLF Financial has been spending more time in the bearish control zone, more time, and then barely any time in the bullish control zone. So now that we're under the 200 exponential and simple, and we have a bearish slope on both of those, they're both negative, no longer blue, now they're pink and red. So now we're in a bear market. So now whenever we see the bulls are in control and we're in the bullish control zone, then we want to treat that as a sell. You know, arguably this one could go either way because we were technically still bullish through here. But from now on, whenever we see that red print on the background, that's going to be a sell indicator to re-short or re-enter your shorts or re-hedge or just sell, whatever, however you're looking at it, because now it's counter the trend. The bulls are in control, but the bears are really in control. The bulls just showed a little strength. So everybody's going to sell into that strength. The same way, though, that every time we come down to the bearish control zone, we don't leave the bearish control zone and say, oh, quick, you know, close all of our positions. We don't want to be short anymore. Buy. Because we're immediately right back in the bearish control zone. Then we sell off again. Then we're right back in the bearish control zone. Then we sell off again, and we're right back in the bearish control zone. So when the bears are in control, we expect to see a bunch of green in the background. When the bulls are in control, we expect to see a bunch of red in the background. When the trend has flipped from blue to red, now we flip them as well. So buying opportunities are green in a bull run. Selling opportunities are red in a bear run. And then we ignore the other signals, obviously, because we don't really care if the bears are in control when we're in a bear trend, because we're expecting that. So we're not just like, oh, the bears are losing control, but they're still macro in control. They're just giving up a little bit of ground. That's how you it's sort of like a tug of war. You know, the bears are still getting, you know, completely destroying the bulls, but the bulls have gained back maybe, you know, a little length of the rope is all. So hopefully that extremely long, extremely basic explanation was worthy. Hopefully someone out there got something out of that random explanation. I mean, it's probably pretty obvious to most of you guys, but I do like to continually touch on the basics just to make sure, you know, if somebody's just coming on or, you know, maybe miss something along the way, we can always kind of reinforce that foundation. But overall, obviously, financial looks terrible. So, yeah. XLV, okay, so we've got healthcare. Again, we're still looking at this neckline or the support in white as the main area that we're watching. So as long as it's holding up, this looks okay. If it breaks down, it's going to look like a pretty clear double top. Or we could see some sort of like, you know, you see sometimes like strange patterns that aren't like completely what you're normally used to seeing. But we could see something like this where we actually have like a double top as the head of a head and shoulders. And then we get something like a right shoulder like this. You know, and then obviously like, you know, it would still be treated the same way you would treat a head and shoulders. But the difference being that you actually, instead of having like one head in the middle, you have two heads. And then they're basically just a double top. So on the macro, we have a shoulder, then we have, you know, two heads, double top, and then a right shoulder as well. So, and again, it's just the mentality of it. We came back up to this area and we couldn't get past it. We couldn't sustain above that. So we topped out and that was our double top. The same way we would expect potential resistance around where we put in our left shoulder, because that could potentially act as a lower high weakness that would correspond to a previous resistance or support area. So again, doesn't have to happen like that. We could just break down right away. But just to be aware why we don't short into resistance or why we don't buy into, short into resistance or buy into support. No, that doesn't sound right. Nope, that's not it. We don't short into support and buy into resistance. That's the one. Because we could easily see, you know, this isn't going to be some massive crazy move, but we could easily see this next bounce take us back up 9% to here. And then that would look like a shorting opportunity for potential to come back down. And then we see that break. But, you know, if we were looking to short, we would have shorted the high back here when we're talking about the double top. We don't want to short now at support. We want to short at resistance. And the next resistance we're going to pay attention to, you know, and I'll just throw it up on here. Obviously, this is all theoretical at this time, but, you know, something to the effect of this, we would pay attention to that acting as resistance. And then this would look like a big distribution pattern, a breakout that failed or, you know, a throw over, and then a breakout that failed again, or possibly even a second throw over. and then distribution has been taking place the whole time inside this channel, and then we eventually break down from the channel and get the measure move much lower. And again, the only reason we're being bearish on this right now, obviously you guys know healthcare is a safety play, but we are now below the 200 exponential and simple. We retested them and we're breaking down. So it makes sense at this point in time that we actually will break down from this area. Now, another push up here could happen. Maybe it doesn't. And we just immediately break down. Maybe it flips to 200 exponential and simple, back bullish temporarily, and then it breaks down with a little fake out. It's just about how much strength is in the markets right now and looking at the hypotheticals, so we're not surprised when one of them plays out. So that being said, that is our healthcare sector. And then XLU. So utilities, we talked about the macro channel. We talked about the key support levels. We're back just on top of the higher one of the two support levels. So we're looking at basically this as a key area that we've had price action. We're back above it. That's good. It's okay for now. Definitely, this is one of the stronger sectors in the market. And again, safety play. So we see here XLP. I told you we were going to talk about consumer staples. So we've been discussing this chart recently and the consumer and all this stuff about how the big pitch is the consumer is strong and blah, 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 and all this. It's obviously, a bunch of bullshit. We know the truth. Anyone that's not completely out of touch with reality knows the truth, that the consumer is not strong. And obviously this has played out as expected. So we came back down to the support area we were watching, which is 71.38. So not only did we get the breakdown, we were discussing this last time. This was our previous low, and we expected to revisit that. But not only did we get the breakdown from the 0.5 and this key support area right here, we immediately touched the 618, bounced back up to the 382, and then completely capitulated. So that was what we discussed, was after we hit the 618, pushing back up to put in another lower high. We didn't know where that was going to be exactly. But again, now we don't even need this anymore because we have actually come down, beyond where it's useful. So we're now below the 200 exponential and simple. We're now at that key support, which was the previous, top and bottom along the way. So this clearly had something to do with, earnings, which really weren't that bad, but more the guidance. Walmart obviously got just completely wrecked. We saw Target, a couple others, just some key players in the space. So now we basically have heard from, a bunch of important retail or online retail businesses, basically, Amazon, eBay, and now Walmart, Target, a bunch of these other companies, important businesses, or arguably you could say staples, coming out and saying, hey, things were okay, but they're probably not going to be good going into the future because of X, Y, and Z. So that being said, we're at that key support now. We're below the 200 exponential and simple. There is going to be a big gap on a lot of various stocks because of this. Is that gap fill going to get played sometime soon? Probably not. This is probably the type of thing where once you get this breakdown, we don't come back up and give you a second chance to get out of it. Now, it doesn't have to be the case, but it seems very likely to me. So we're now at what should act as a key support area, at least temporarily. We were getting a lot of respect out of this channel temporarily, even with the breakdown, and then coming back and revisiting the heartline from outside of it. So we'll see if it holds this time. But this is obviously not surprising. These are supposed to be the safety plays. This trade obviously got a little too crowded. And again, that makes me think that there's more people than you would believe or that are voicing their opinion that maybe this inflation is not going to be as bad as you think going into the future. Especially if we start to round like those year-over-year numbers. Because obviously consumer staples, healthcare, real estate, all these things are supposed to be, utilities. They're supposed to be the safety plays during recession. So if all of a sudden we're seeing the safety plays during recession take bigger hits than the overall broad market, or at least equal, that tells us that some people aren't buying this as their hedge, etc. So the difference between the growth and the so XLRE, So real estate, we were talking about this kind of like slanted head and shoulders. Again, seeing a lot of like double topping, kind of head and shoulders, distribution patterns, breaking down below 200 exponentials and simple. It's the same thing that always happens at the top of every bull market. Distribution takes place, topping patterns, breakdowns. We lose the 200 exponential and simple. I mean, this is just textbook bear market starting activities. And again, this is just the beginning. Even on real estate, or obviously on real estate. So we're almost down to the target. I think it was 20% target. We hit the first 12% right away, last 20%, a couple of points away. But we did come back up, retested the breakdown. So this should have acted as support. We break down through it. It comes back up, acts as resistance, and then we get the sell-off. We didn't take out the low, which is okay. I mean, we're like 30 cents away, though. And there's always tomorrow. Remember, we didn't run out of sellers. We ran out of time. There's no big buying wicks that came in at the end of the day. And it was like, oh, we ran out of sellers. That was it. And then the day closed. And people bought up the dip. No, it's the opposite. The day ended and we were at the lows. So we didn't run out of sellers. We ran out of time. So we would assume that tomorrow the selling will resume. And that's obviously what I would expect. And then all these ones that didn't quite take out their lows, probably take out their lows. I think probably in the next couple of days. Maybe by the end of the week, we get our 39 target, the 382. Our twin. But we'll see. Obviously, we're at that previous peak right here. So this is that key level we were paying attention to. I'm going to put that same line on too. So we keep our eye on it. I'll just turn it yellow for now. So when we come back down to that, we bounced it. So we basically hit support, hit resistance, and now we're back at support. So maybe we bounce back up and consolidate a little. But I think eventually the slinky theory kicks in and we go down a stair. So VWO, FTSE Emerging Market ETF, still hanging out at that 0.5. That was a key support area. It is holding for now. It looks okay. We've reclaimed that level. We don't see divergence between these points, but we do still have the macro divergence taking place between these previous peaks. So we potentially looking for this to get a bounce. Now, we came really close, and then we got a pretty big bounce way above the 382. Came pretty close again, retested the 382. So now that we've hit the 0.5, are we going to retest the 382 again? Maybe, but probably not. We've had so many opportunities to reclaim that level. It would make sense to me that we actually end up going lower. But we'll see. Overall, it has some bullish undertones, but it probably goes lower. DAX. So, I mean, it's technically still respecting that resistance, at least for the most part. Depending how clean we had this drawn on here. It did technically move above it and came back down. 821 is about to cross back to the upside. Looks okay. Again, still waiting for this to come down lower. Could easily finish out this move, though. We'll see. Just missed that one. CN50. So China. So we're talking about if this can consolidate above the 8 and 21 and get the cross to the upside, we could start looking for this potential move. But it was only a 2-to-1 risk-reward ratio, so it wasn't even worth it. And we'll see exactly what happened. We could not hold those levels. Therefore, we're not going to want to enter the trade, obviously, because in order to go to the upside, it needs to hold above the 8 and 21, potentially get the cross, and then that's probably going to give us our retest. So not only do we not have a favorable risk-reward ratio because we're in a bear trend, we want over 2-to-1. We probably want closer to 3-to-1 to take it to the upside. But in order for that to even be a possibility, we needed that 821 cross to the upside. So again, just showing some weakness on China's part. Failure to be able to hold key levels. So UK 100. So we did lose the yellow support after reclaiming it. We did reclaim the 200 exponential and simple, but we are back down there revisiting them again. So we'll see what happens. I think we at least come back down to the 236, and then after that we'll see what's going on. This got a pretty aggressive bounce. It went down really fast. It went up really fast. So, I'm not convinced that we don't go lower here. We'll have to see. It's a tough one. As long as we're still technically on top of the 200 exponential and simple. So that is a good sign for now. So got to give it favor that maybe we would retest that or the 236 would hold. But this doesn't, just the way the price action looks is not particularly bullish to me. It looks like it's just lagging behind everybody else that already rolled over. So EWZ, Brazil. So we were expecting that move back up to the 200 exponential and simple. We got it. We're starting to see that rejection. So we're looking for it to come down slightly lower. Again, not to be greedy, but we're really looking for an entry around like 29. We made it all but to that level, but not quite. Possibly again a retest of, the lower end of the range, all the way down at like 24 or somewhere around there. So we're really just looking to see how this price action plays out for a potential entry off of this support if it's going to hold. Otherwise, we're looking for much lower prices. All right, so look at the DXY. What's going on, Arturo? Hey, Sotos, good to see you, brother. Sohail, good to see you as well. Hey, Yoda, hello to you as well, and everyone else. Kalma Betty, Bitcoin to 10K. It's so funny hearing people like root for Bitcoin to go lower as if it was like the Moon Boy mentality. It's like the opposite Moon Boy. Turo X says, she ran after the garbage truck yelling, am I too late for the garbage? No, jump in. Exactly. So DXY, we got room for one more, man. DXY, really just been expecting this to show a little weakness, but it's just staying strong. So not quite getting down to the 21, bouncing back up to the 8. It looks like we're getting a rejection. Probably comes back down to 21 again. Trading in a fairly tight range. Still extremely bullish. Left the bullish control zone. Hard sell signal. Bunch of red histograms. Histogram is at the slope, though. Usually does get a bounce right here. Maybe even higher, and then we print some bearish divergence, and it goes lower. Still very bullish. Short term, a little less so. So Tesla. So we came back down here, revisited the lows once again. So we're seeing that same pattern that we're seeing all over the place, where we basically have like an initial push up and then a lower high, or a push up and then a slightly higher high, but basically like a double topping potential pattern. We have a bunch of different levels through here. Let's get rid of this one. Trying to just kind of break these down a little bit, get rid of some of the less important stuff. So now we just have this low right here, which was the low right there. So if we lose this area, there's quite a bit of price action that took place in between, but realistically, that probably just leads us down to our 236, which again is going to act as a strong support because that was the bottom of our triangle when we held support right here and then got our bounce up for that one more drive to the upside. So again, Tesla trading very, very technically. At this point in time, it looks like it does want to come down here to 236. So, if you missed your opportunity last time when Tesla was at $536, have no fear. Looks like it is headed that way in the very near future. So I'm still respecting this sort of downward channel or descending broadening wedge, depending how you look at it. So we'll look for those key areas. We did kind of just basically break down, retest, and then it looks like we're going to get continuation. So NVIDIA didn't quite take out the low yet. This it printed a little bit of bullish divergence. We talked about potential here for a long trade back to the upside. Obviously that's a risky one because this, markets are very weak right now. We did come out of the bearish control zone, got a hard buy signal, printed bullish divergence. It's a tough one if this is realistically just even a better entry or not. Obviously a counter trend trade, and we're kind of just bouncing in the middle of nowhere, like nowhere. Maybe the peak of the one. Yeah, this one could go either way. It looks like it does go lower, but there's still some potential here. And again, nice risk reward play out. So we'll see what happens. If we hit the stop area on a daily close below that, obviously, we can just look to re-enter lower. And that's the point. We'll just limit our downside risk and then just still capitalize on upside potential. Because eventually we'll get a reversion to the mean retest of a 200 exponential and simple. It doesn't have to be here, though. But we did see some potential favorable conditions, and they do still exist, at least for now. So Apple, again, seeing a bunch of weakness out of Apple is weighing on the markets overall. So we're back down here, new close on Apple. We're at that key support level, holding for now. We made it down almost to 236, but at this point in time, we've touched our box area for like the second time. So this should act as pretty strong support right here. But the truth is we probably just put in a lower high and go lower. And Apple has technically confirmed into a bear market now. 200 exponential and simple have flipped over bearish. We don't see any bearish or bullish divergence or anything telling us this is going to be a bottom. It's a key support. It acted as support quite a few times. But at this point in time, Apple is finally showing some weakness. I mean, a couple big things have held strong for some time, and they've been holding up the markets. And now those things are starting to fail. That just tells me, like, look out below. Get out of the way. Microsoft, again, new lows. It had already broke down pretty aggressively. It's really looking like, again, one of those head and shoulders patterns playing out. Very clearly, bear market below 200 exponential and simple, slope to the downside. 382 target just below us. And then we have the 0.5 and the measure move slightly lower. If we look at Microsoft and we look at the weekly, though, we still have a ways to go before the weekly, but it does line up with that 0.5, depending if we're looking at 200 exponential or simple. Bears have officially taken control. Does not look good. Microsoft looks like it's ready to revisit like 220, possibly a little lower. And that may just be the start. We don't know how low these things are going to go. Are they going to play catch up? I would imagine they'll stay at least slightly stronger. Amazon, again, we hit that $2,000 target faster than I expected. And now we got a decent bounce out of it, 10%, but it's right back at 2142. So not a new low, but right back at those lows. So are these going to end up being tradable bottoms? I'm not seeing enough out of any of this. I mean, it's starting to build a little strength, but then it just gave back so much, and that's such an aggressive bearish candle. And the way the rest of the market looks too, and their guidance, and there's just a lot of reasons to just not be a buyer at these levels. I mean, I like these levels, but not in the current circumstances. If we were starting to build momentum and Amazon was trading at 2,000 and it was showing some bullish signs, I would probably be a buyer at 2,000, like we discussed previously. But it got there so fast, and it still looks like there's a lot of juice in the tank on a lot of these, major indexes and, big players. We've only just begun a tightening cycle. I mean, it's crazy to think that this could go on for a year, 2 years, 3 years. Obviously, that's unrealistic, but imagine 3 years from now, they're still like raising rates and selling down the balance sheet or letting the balance sheet run off. It doesn't even seem possible, but it is a possibility. But what does the market look like then? Really, really bad. So Netflix just continuing to just melt down. There's no buyers coming in. There's no support. Headed to the 382, $123. This thing's about to get wrecked. Somewhere around there. Call it 123 to 130 because we don't want to miss that. Because that could just be juicy opportunity. Because this thing has just gotten beat down. So Google losing the 236, retesting as support. Nope. How about losing the 236 as support, retesting it as resistance, now breaking back down to the lows. Looks like it's ready to go lower, 382. Again, looking for that $2,000 target on Google. Very weak for one of the stronger players. And again, we see the 200 exponential and simple rolling over, clearly in a bear market. Same with Facebook, clearly in a bear market, clearly trash, holding that final, area of support for now. The 618 and the ascending broadening wedge. So this is it. We're at support. We've hit support multiple times. We broke down from support. We reclaimed support. It looks weak. So 786 looks very, very likely. So $156 Facebook soon. No, I doubt it. Because Facebook doesn't exist. It's meta, bitch. All right, so Walmart. So obviously we saw Walmart situation. We saw how it affected consumer staples. And again, not surprising. We see a very similar thing going on here. That we see on the actual consumer staples chart, where we've revisited that previous low that we put in before the high. Actually have taken it out slightly on Walmart. What do we have on here? Okay, so we had our little channel that we were acting in. We had the throw over. Revisited the bottom of the channel with that first gap down. Couldn't reclaim it. Second gap down took us to a new low from the previous low. And then third gap down took us almost perfectly to the measure move. So at this point in time, we've hit the measure move of our trading channel. Let's get a... So I think we realistically need to be... I mean, normally we would fib from the Rona lows, but I'm not sure if that's actually going to be the way to go. Let's see how it looks. Okay, that looks pretty good. The other thing was this is clear, pretty big swing low, but that was back in 2018. So I do just want to kind of see how this lines up. You might want to just pay attention to this for like the macro look, just in case there's people watching that one as well. So we have our yellow fibs and then we have our white fibs. Just in case this was being respected as the swing high and then this was all one move versus if this is one move right here, you know, and that was its own move, arguably. So when it's all said and done, we see quite a bit of interaction with the white fib on the way up and on the way down, and with the yellow fib as well, with the 0.5618, almost like perfect retest. So we have already basically made it to the 382. So the next level, if we continue down from here, is going to be like the 0.5786 down here. So look for somewhere around this. I mean, how much more beat down can Walmart get? I mean, pretty beat down, honestly. But I mean, we already lost. This was the 2020 level right here. So that was basically the support the whole time. Right? Yeah, this was April 2020. So it basically sold off, rallied, and then went sideways. Finally put in a new high in April of 2021. And then just is now breaking down. And in the time that it broke down, it now has broken down powerfully enough that it has wiped out back to November 2019 gains. So, and I mean, you know, this is the Rona dump bottom right here. Or no. Yeah, that was the Rona dump bottom right there. So that's 117. We're at 122 right now. So, I mean, this thing has just given up so much. I mean, was that? That's wild. 25%. You know, and realistically, the majority of that came, you know, in a 3-day period. Yeah, 17%. Wow. So yeah, that's some pretty powerful selling. Gonna have to see some serious, strong buying coming in on Walmart. That's a lot of volume too. And almost, you know, we're seeing like no wick at the bottom. We basically just closed at the lows. But this is, I mean, how low does it go realistically? We probably do get there, like 110 to 115. You know, that may be a buying opportunity. But again, it's so early into the selling. I mean, we're 3 days into the selling for this particular stock. Obviously, some stocks have been getting beaten down for over a year. But, you know, bottoms usually happen slowly when no one's looking. Especially the type of bottom I'm expecting. So flipping over to our cryptos. If you are just tuning in, obviously none of this financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. Make sure to smash up that like button. If you're not currently a subscriber, you know, definitely subscribe, or else you won't be subscribed, and that would be terrible. But that's it. No further repercussions. Let me wet my whistle real quick. Give me like 2 seconds, and then we'll keep rolling. All right, much better. So our Bitcoin futures chart. Did we close? We'll see when we get to spot. I was paying attention to the daily right here because we were very close to closing our new low on spot. Yeah, we did. Okay, so we closed a new low on the Bitstamp chart, but we didn't close on the daily. But we didn't close the new low on the daily on the futures chart. So futures chart looking slightly more bullish because we at least have 3 green histograms and we don't have a new low. So slightly more bearish now, or bullish. Now, Slightly more bullish than what? Well, not good, because we're below the lows from 2021. June, July. So that is not good. We're basically consolidating below the lows. We were talking about it in the trade group the other day, and I basically said, 30 grand is the area to watch. There's a lot at 30 grand. 30 grand was previous support. 30 grand we would expect to act as support. It was support back here as well. It's Michael Saylor's, $1 billion entry price. There's a lot of things at 30 grand. It's a nice round number. We have a bunch of different reasons to watch that level. A bunch of reasons to pay attention to that level as support. The macro 236, there's tons of reasons. So as long as we're below that, that's not good. It doesn't look good. So, and again, bearish control zone, hard buy signal coming out of it, 3 green histograms. So that's good. It's typically the beginning of what we're looking for. But again, now we're in a bear trend. So we're not treating that nearly the same as we would treat a, bullish situation in a bear market. Because obviously we're below 200 exponential and simple. So still looks very, very weak to me. Looking at the actual weekly. So we didn't quite get to that 200 exponential, but we're already bleeding out. So again, if the end of the week closes where it's at right now, we have a new weekly low. If it goes slightly lower, we have a new daily low and a new weekly low. We're also getting a hard sell signal and a bunch of red histograms. Doesn't look good. And I mean, at this point in time, it looks like we're coming to 200 exponential and simple. I mean, we're right here. So, I mean, my real target at this point in time is 22,000. Once we hit 22,000, and then at that point in time, it's like, well, if we go to 24, could that be the bottom? Well, might as well go to 22.10. And if we go to 22, might as well retest 20. So, every $2,000, it's not very useful, but, that's really what I'm looking at this point in time. And then monthly, we still have plenty of time left in this month, but obviously a very, 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 very bearish candle on the monthly. Clearly, at this point in time, with the exception of some kind of like miracle rally back above 37, 38,000, this looks real bad. Because we likely get next month a retest of maybe 37,000. Maybe we don't, but we do get a cross either way probably of the 821 to the downside on the monthly. With all red histograms and diverging stochastics, not good. Looks like we're headed to Rack City. And again, that's our previous high. 20,000 was right when futures, was implemented, was literally the high. So we would expect even on this chart, even though it only goes back to that previous high, we would expect that to be support. And again, 20,000. So it does not look good right now. Does not look good. And a matter of fact, it looks like our macro view on Bitcoin is playing out perfectly. So we have basically a leg down, a consolidation channel back up, and then another leg down. And the leg back up was 50% of the previous leg. And then we know our extension to the downside. This, in this case, is just the length of the initial thrust of that flag, or the flagpole, and then consolidation. And then we see another flagpole to the downside. And then we see also on our macro, depending how we draw this, because there's a couple different ways you can look at it. In this case, the white Fibonacci goes all the way down to the bottom, or I'm sorry, yellow, goes all the way down to the bottom, and then comes all the way up to the top right here. And as far as we've broken down from there, below the 236, the next target would be the 382. Now, there's a lot of different ways you can draw this. You could draw this Fibonacci at the top to the previous high and say that this is actually part of an expanded flat correction, and that this was the peak, and this was just a higher peak, wave B, before our continuation to the downside, or second wave. Arguably, you could take a Fibonacci, and instead of going from the bottom right here at 3,000, you could go from the Rona dump, and you could say, well, that's where we should be fibbing from, and that would give us slightly different results. So that would put our, let me switch the color on this one. I don't keep them all on here because it just gets so crazy, but it's worth paying attention to. So let me make that one brighter a little bit. So that would be an alternative to the yellow one. So we see here, we were getting a lot of respect at the 236 initially, and we were also getting, nope, not the yellow one. Sorry, the green one. Yeah. So we're getting a lot of respect at the 236 right here. And then obviously the 236 of the green one is where we touched down to right here. So now we've lost both the 236s. So the next 382 would be in white right here at 24,000, 23.6. and the next 382 in green would be right here at 21,000. So again, we have some kind of like gray areas of what we should be looking at. In my opinion, the most important one is the macro fib from the bottom to the top, but it is worth paying attention to both of them, as we could easily see a perfect bounce off of one and not the other. And if you're only looking at one, you could miss it, honestly. You know, you're not going to miss the next bull market, but you could miss like a tradable bottom. So now our Bitstamp chart, Bitcoin on the daily. So again, we did put in a new low on the daily, so that is bearish. So days without incident, back to 0. So we made it 5 days without a new low. Well, here's a new low. So new daily close. You know, Bitcoin still looks like trash. Clearly in a bear market, just garbage. Completely losing key support areas. Not good, not good. So we had an aggressive buying wick off a capitulation sell-off, but it just looks like it's bleeding out. So I think we head right back down to probably new lows. We are seeing a hard buy signal, a couple green histograms. So, you know, there's something. We did touch the 200 exponential already. 200 simple is at 27.2. I'm sorry, 200 exponential is at 27.2. 200 simple is at 22,000. So again, we're just watching those key areas. Weekly close. Again, we'll print a new weekly close. If we were to close right now, hard sell, bunch of red histograms, doesn't look good. And then the monthly, same thing. We're likely to get that 821 cross to the downside in like the next month or two. We do have the histogram at the slope line, so a lot of times we'll see some kind of bounce right here. So maybe we do see a lower low close, and then next month, say we close this candle right we're at right now, 29,000, and then next month we just bounce back up to 37,000 to retest and try to stop the 821 from crossing down. We get the bounce of the histogram off the slope line, and then, you know, again, trick people right back into the market, because that would be a nice, you know, that's a 25% move. Let's say we close right here and we retest back up into that area. You know, just a retest of the 21 is probably 25% move. If we retest the 8 and try to stop the cross from happening, we could easily get like 30 to 35% move. And again, people would say, oh, that was the bottom. You got tricked. Should have hodled. You know, should have bought the dip. And then we just go lower. It's just a retest and we break down lower. Here we did not see that. We just capitulate. And then we capitulate one more month. And then we round out the bottom. Here we obviously break down, save the trend, and then break down, capitulate, but never actually cross the 821 to the downside. So, you know, true bear markets, we've had always the 821 cross to the downside. So this was a 4-year cycle bear market, 4-year cycle the bear market. So, you know, we'll know the 4-year cycle is real if this 821 crosses down, because it's only ever happened in the 4-year cycle bear markets. So if it happens this time, we could be like, oh, that's just a coincidence. Oh, the 4-year cycles are over. Or we could acknowledge reality that Bitcoin's doing what it was programmed to do mathematically. Not what the white paper says, but, you know, at least mathematically, the 4-year cycles. So that being said, let's look at this chart here on the monthly and see. It's probably a little too nasty to... So we're still looking at some key areas. Let's switch to the weekly, actually. Probably be able to make it out a little better. So on the weekly chart, we see obviously our A, our B, and then our C is in action right now. This is my theory, which was that the 5 top was actually at like 64K or 60, whatever, 6K. And then we actually did an A. That was our B to a new high. And then we're actually putting in a C lower high. And typically the way the expanded flat works, you know, you can count out the waves perfectly. And we had an ABC to the upside, and that made up our B of the expanded flat. First we had ABC to the downside, then we had ABC to the upside, and that was the A, the B. And then we saw after that, we'll see a 5-wave structure to the downside that composes the C. And so far of that 5-wave structure, we put in a pretty clear 1, and then a 2 peak right here, which was a roughly 50% pullback of the move from top to bottom, which is very, very technical. And then we put in our 2, and then we rolled over, we broke down from the channel, the flag broke, and now we're putting in another length of the flag pole, which was also going to make up our potential 3 of the third wave down. So now we did actually like come really close to hitting my target. My target was just generally between the 200 exponential, the 200 simple, and, you know, obviously this was our green box. I thought it was going to take a while longer to get there, but, you know, we did technically get there already. Looks like we're going to go lower, but eventually somewhere around here, we're going to find support somewhere between, 28 and 20K. We're going to find support somewhere around there. And then when we get that bounce, wherever that's from, whether it's all the way down here at 20K, whether that was already it right here, etc., what we're looking for to play out, what we're expecting to happen is a fourth wave back up, which would take us no higher on a weekly chart than roughly a weekly close could not be above 36. So maybe we're actually really close to that happening. Maybe we're really, really close to that happening. Maybe because we talked about, the monthly. So what do we have? 2 weeks left in this month. So this week closes down. Next week closes down. That's the end of the month. And that finishes out the wave 3. And then the new month starts up. And then over the next month, we get a $6,000 pump over the next 1, 2, 3, 4 weeks. And then that puts in our 4, tops out at the top of the 1. And then we see our 5th wave down. Everyone will think that was the bottom. That was it, etc. We've never broken below 200 exponential and the 200 simple in a bear market on a weekly, whatever their argument is. And then next thing you know, we go lower. We retest 16 grand. We lose a 20,000. We break down from the 382. All looks like it's lost. And then in all actuality, what we're actually doing is just doing our macro retrace of the 5-wave structure. So again, I have much lower targets that we could potentially get to in a really bearish scenario, or we already bottomed. Probably not, but, it is possible. Probably not. But, hey, what's another 12 grand from where we're at right now? Come on. What's 12 grand between friends? What's another, $1 billion of sailor's fortune gone? What a loser. Oh, man. I talked about it a while back, and I said, once Michael Saylor's Bitcoin position is upside down, he'll lose his title as Bitcoin Jesus and be recognized as Bitcoin Judas, the betrayer. And then his actual name will be changed legally by him to admit his guilt and fault and uselessness as a human being from Michael Saylor to either Michael Failure, or if he just wants to not go the legal route and just do nickname, I think we could go with Michael the Failure Sailor. Either one's okay with me. So I'm okay with him legally changing it, honestly. It's probably good at this point in time after all the horrible things attached to his name, but it is technically his choice. So, but hey, must suck to be him. But also, you should probably just, sell your family business, sell your house, sell your car, sell your shoes, and then just, obviously go all in on Dogecoin, right? Isn't that what he said? Or was it Bitcoin? I can't remember what he said. Whatever it was, obviously it was not a good decision in hindsight. So anyway, enough joking around. Obviously, do not lever up your positions and be a moron like Michael Saylor. So Ethereum looking very weak. We did get a new close on the daily on Ethereum. Spot market, same as Bitcoin. We did have the wick come down and retest those key levels. So that's the real support that we just need to hold right now. Obviously, we're at the 236 right now, holding on in the meantime. But, this was a key support right here that needs to hold. No surprise, though. If we lose that one, we're going to 382. So $1,000 Ethereum is right around the corner. We already hit my target. My target was 1,800, so now it's 1,000. So if I wasn't right all the time, I wouldn't always have to adjust my targets. Just remember that. We had this macro channel all the way up. We broke down from the channel. We put in lower highs. Ethereum has just been melting down ever since. And I expect it to continue doing so. We're at key support right here. Again, this is just the equivalence of Bitcoin's, $30,000 level. So it's perfect. It's like the perfect area that you would expect it to basically be hanging out at. So, arguably, is it slightly stronger than Bitcoin? When we look at the longer time frames, it is. It's slightly stronger. It hasn't actually touched the 200 exponential or the 200 simple, but looks like it's headed there. A bunch of red histograms about to get across the downside. Ethereum looks terrible. At support, though. Bitcoin dominance on the weekly. So obviously that played out perfectly. We nailed it. So, please don't pay attention to the time cycle portion of this or the time analysis. Pay attention, obviously, to the areas that we're looking at. So our breakout of this descending channel with triple bullish divergence on the weekly, we broke out now and we closed above it. So technically for a breakout, you want an open and then a close above it. So we already closed above it once. So if this candle just opens, which it already did above it, and then it just closes at the end of this week, anywhere above it, it's going to look like a confirmed technical breakout on a weekly time frame. At that point in time, you would expect to get the measure move, which is just from the bottom of the channel to the top of the channel. So that would give us our target for Bitcoin dominance at about 51%, at which point in time, we'd be only a couple percent off of a retest of a 200 exponential and simple on the weekly. 200 simple is actually like basically flat now. 200 exponential still has a little juice to the downside, but it looks very likely that that's where we're actually going, somewhere around like 56.42%. And then we would expect sometime in the future after that, a retest, come back down, potentially retest a breakout of the channel, or maybe slightly less, somewhere around here, etc. But that would correspond with us going into a bear market and Bitcoin gaining strength throughout the bear market, the same way we saw something take place around like 2018 through like 2019. And it looks like that's just the beginning of it now. So once we see this consolidation, and if we see that continuation, it's going to be very clear that we are going into a bear market, and we would expect altcoins to lose value in comparison to Bitcoin, corresponding with the overall trend of Bitcoin melting down and everything else completely fucking melting down. So total market cap, again, just, we've already hit all our targets on this. The next target for the market cap for cryptocurrency is 0 at this point in time. No, I'm just kidding. So we had the 3 trillion top. We talked about a bunch of levels along the way. We obviously hit the 200 exponential, which was that 1.08 trillion, literally perfectly. So we're not the only ones looking at this chart. We have a new weekly low if we were to close right now. Still have a couple days left, obviously. But we are just continuing to melt down. So we would expect this area to act as some kind of support, but 200 simple is all the way down here at 845 billion. So does crypto go sub 1 trillion? I mean, it was just a couple days ago where I literally said, when we were at 2.2 trillion, I said, get ready for us to lose $1 trillion in market cap. And over the last like 6 weeks, that happened. And I said, and I quote, and tell me what your favorite crypto looks like then. So, I mean, it's not like this was a surprise that we broke down from 40K to 30K, or from 3,000 to 1,800, or, whatever your favorite crypto is. We've literally been expecting this. So hopefully you didn't get caught with your pants down, or whatever, I can't imagine anyone on this channel has. I mean, I have been, like, without being completely obnoxious, I've been as bearish as you could possibly be this whole entire time. From before the markets were technically bearish and they were already looking bearish, to now when there's no denying these markets are bearish. I mean, there has been no secret. I have literally used the word trash and crap and garbage and bear market probably 100 times every stream. So it should be very, very obvious where we're expecting these prices to go. And there's no sign of bottom in sight. So Matic hit the 786 perfectly, retested the 618, and looks like it's going to continue melting down. Did not put in a new daily low based on the close. I don't know where this thing even goes to. I need to go and look and see where I can get a better Matic chart than this, and actually like research, because by research I mean spend like 38 seconds on CoinMarketCap. This thing probably goes another 50% down. I mean, there's nowhere left to go. If we lose the 786, we just retest the all-time lows on the Coinbase chart, which is 30 cents. Nowhere to go. Bear market. AVAX, bear market. Again, we just hit the 1.618 fib extension, or the 2.0 to the downside. Could not close back above the 382 for that potential scalp back to retest. It just looks terrible. It looks terrible. Not being able to break back above the 1.382 and get back up to retest the breakdown. Obviously, crypto is just weak everywhere, but it looks terrible. And again, buy, sell, buy, leaving the bullish control zone, bunch of green histograms, but it's going nowhere, and it's back at the low close. So likely goes lower. And then what we should see, it looks like a lot of these things want to go lower and then print bullish divergence, and then we're probably going to get a sick rally, like 20, 30, 50%. So that's what I'm looking for. I don't want to like encourage people to look for bull rallies in a bear trend, but they're usually like really quick and really profitable. They're obviously counter trend. so they're less likely to play out. They have a higher probability of failure. But that being said, I much prefer to, I always prefer to trade to the upside than to the downside, just because of the risk reward ratio. You can only make 99% going down, but on the way up, you can exponentially win. And eventually, most of these assets, even some of these cryptos, I do expect to eventually go to new all-time highs, with the exception of things like Dash and XRP, completely dead projects that no one in their right mind would ever purchase or invest in, at least now after knowing. Maybe initially you were ignorant, you bought some XRP because you heard some stuff about it. But once you are educated in it and you realize, it's complete trash and a garbage project, there's no excuse to hold it at that point in time. You would obviously be better off just liquidating that at whatever loss in that horrible investment you made and then just putting it into something good. Anything at all, except for Luna or Dash. You'd probably be better off. You probably could buy Rocket and do better than XRP. But that being said, when it's all said and done, these meltdowns continuing to happen and some of these cryptos not putting in new all-time highs, the probability of them putting in a new all-time high is almost gone to zero at this point in time. So realistically, if you have a crypto that did not put in a new all-time high this cycle, under no circumstances should you have any money invested in it. I mean, in my honest opinion, obviously not financial advice, but if you go a whole cycle without putting in a new all-time high and other assets in that same class put in a new all-time high, you're like at the racetrack betting on a horse that used to be good, but now it only has 3 legs. And you're like, yeah, but it won the Derby like 5 years ago. And you're like, yeah, but it has 3 legs now. And you're like, yeah, but it won the Derby. Like, it was the winner. It was the best horse. You're like, but it has 3 legs. XRP, it has 3 legs now. Maybe 2, maybe 1. Maybe not even. Maybe there's like some weird stuff going on there. And it's just kind of like crawling around on its belly like a slug. It's all greasy and grimy and slug-like. I mean, ugh. Just thinking about XRP makes me feel gross. Ugh. All the lack of gains that you would make if you would invest in that trash. But anyway, back to Solana. So Solana, not looking great. So we already retested 786. A lot of these things, I mean, $20 is the, there's nothing left. We already tested 34. We're back at 50. So the next downside target is like, $20 to $24. But at that point in time, these things probably are just going to roll over. Monero obviously got the bounce back up to retest the top of the channel. So now it basically had a nice breakout. I think realistically, we saw the most price action. This channel was okay. It was worth paying attention to. But this is a pretty good channel. And this was our initial channel, obviously. Once we got the push up here, we came back down. Didn't hold the top of the channel, but we hit the heart line perfectly. And then from the heart line, we retested the resistance and hit that perfectly. So it's very clear that this is what the market is looking at. So we have to be real careful here. Don't want to get too overly excited for this potential handle to develop. But at this point in time, looks like it wants to go lower. So it already had, 25% sell-off or something like that? So we'll see. I mean, it could still come down here to like 81 and it still wouldn't like break structure technically. But it looks pretty weak right now. Back below 200 exponential and simple. Not good. So Algo found some support at 618. Found some support at the bottom of the channel. Back at the lows again. I mean, we already hit the 618. We already hit the target. So where does it go from here? I mean, I don't know. It probably, it already got a bounce off of this level. So I don't know if the market even gives it another one. A lot of these look like they're ready for just another leg down. They already got like their reflex rally back to resistance, immediately failed and gave up most of it. And now they look like they're ready for another leg down. So I guess 20 cents on Algo, I don't know, or 53 cents. So it's 10 cents up or 24 cents down. So again, obviously these bear trades are looking a lot more appealing. So this was holding up okay. Polkadot was, but again, it's hard for me to be bullish on these things. We already put in a new low. Again, obviously I'm looking at Coinbase charts here, so there's probably a better one, but just looks very weak and there's nothing left. There's no support. A lot of people bought into this probably on Coinbase, biggest exchange in the United States. So anything that everyone who has bought it is a loser now on that entire exchange. is really just not good. So Hex capitulated. Well, I shouldn't say that. Had a pretty big sell-off. Percentage-wise, it probably looks pretty brutal. But it did have a nice dump back off of the 200 exponential and simple. Yeah, 36%. Pretty brutal. Back at that yellow support. Looks like it's headed to the bottom of the channel. Obviously, this is playing out perfectly. So it looks like we're basically getting ready to take a fifth leg down. Now remember, this is not like a Fibonacci, like official. I was just showing the bounces off the top and the bottom and where I expect another leg to go. So don't worry about like the 4 being above the 1. This is not technical. I just use a drawing tool because it's easier than doing like individual lines. All right, so that's our cryptos. Let's take a look at some gold action. So obviously gold, once we lost that 840 level or 830 level, there was a couple levels we were watching. We lost that. It's garbage. It's trash. It's useless. Hard buy signal coming out of the bearish control zone. Couple green histograms. It's okay. But, I mean, where were the bulls to save price action? We're now below 200 exponential, negative slope. We're now below 200 simple, flat slope. That's not good. That is not good. The bulls had all the opportunity in the world to break this out or at least hold support, and they did neither. So now we're getting 821 cross back to downside. We're getting the exact repeat of the 2011, high with a little bit higher of a spike, a little higher of a wick right here. But, that's just FOMO probably kicking in. But now it looks like, we're potentially going to get that play. So, without getting too crazy with it, if you did like, basically something to the effect of just a bars pattern like this, and then it will basically just put that price action, and then we can kind of extrapolate it over here and see sort of what did that look like in comparison. If we put that, let me make this a little brighter. I'm not sure how good you guys can see that. So we make this a little bit brighter and we put it on there. It's not perfect what happened, but we basically had that consolidation. We had that push up. So maybe if we just stretch it out a little bit, we can make it look a little more, something like this. Consolidation around here, push back up, and then it just sort of fails, rolls back over, retest 200 exponential and simple, and then cross. Now, it doesn't have to happen like that, but that's what happened last time, and it sure looks really, really familiar. And then, also, when we look at the signatures on our indicator oscillators, we see the weekly histogram rolling over. We see a hard sell signal and the Stoch's powerfully angled to the downside. Here again, we see the same thing. Hard sell signal and the Stoch's rolling over. Bunch of histograms angled to the downside. And then that was our 821 weekly cross, which again, turning off the drawing tools, we see we just got that 821 weekly cross. Now it happened a couple times here and held support, so it doesn't have to break down. But what if it just retests the lows again? Well, that's a 200 exponential. So that's 1682. And if it goes there, it probably goes to 1640. And, that's likely, that's obviously last line of defense. So if it goes lower than that, it's big time trouble. And then silver obviously looks terrible. New lows, completely selling off, coming back up to retest our breakdown. So, we obviously have our channel and it looks more clean on the weekly. And then on the daily, we have a clear support right here. We're back at it, retesting it as resistance. It looks like we're headed to like 18 bucks. Probably take a little pit stop along the way. 20, then 19. But, I mean, broke down below 200 exponential. It's already negative. Barely, almost touched a 200 simple. It looks terrible. Hard sell signal, bunch of red histograms. 821 weekly crossing down. I mean, silver just looks so terrible. Gold silver ratio above 200 exponential and simple now, trending to the upside. If we consolidate above 200 exponential and simple, that means, silver is going to go through a rough couple of years compared to gold, which also probably will go through a rough couple of years. XPD palladium looks terrible. Likely goes lower, back at 2000. Couldn't hold 200 exponential and simple. So platinum is back at the lows, retesting them again. Could not hold that level. It looks like platinum is headed to some of these lower targets, probably in a hurry. So the bottom of the channel, obviously we have we have one touch on the bottom here, so it's not that reliable. But then we also have a bunch of interactions on the heart line that are pretty crisp, pretty clean. And then we have 3 on top here. So I respect this channel pretty clear, pretty cleanly, and expect somewhere around like, it could be anywhere. Maybe it's all the way over here, and it lines up the bottom of the channel and the fib, maybe, you know, we touch right here and then we get a push back up and then we come lower. We don't know yet, but, you know, likely headed down to like 850 or something like that. Just absolutely terrible. What a just, I mean, I can't even imagine. If there's anybody out there that's like a platinum, like bull, like hardcore, like platinum maximalist, you're like the XRP guys right now. You're like, oh, I picked the worst asset. I'm the only one who didn't make money. Oh, it sucks. So ACB, so we got a pretty aggressive move back up here. So, you know, put in a new low, came back up, reclaimed that level as support. Looks okay. 821 needs to hold. You know, we've seen a couple fake outs already where the 821 crossed up. This one really sucked because it basically didn't even get the retest of 200 exponential and simple. At least here it got the retest. So maybe this one, if it plays out, gets the retest up here. So we'll see. We've had so much bullish divergence printing on these things, and they just continue to go lower. It's hard to even respect it at this point in time. I don't know how many more people can sell. I mean, these things are like $4 now, these pot stocks. So not many. It's got to be almost at the bottom. I mean, it is. It's only got $4 to go. And then it's at 0. Tilray on the daily, same exact thing. Just rallied back up to resistance. Holding for now. Looks okay. I mean, do we want to just be like, oh, this is the bottom, this is it? No. And you know what? This thing already had a pretty aggressive move. So what do? Do we take that same trade over again? Like, do we basically just enter, you know, something like this and just look for that pushback up again? It's possible. I mean, I don't think it happens though, but it could. 16% stop loss, 73% upside potential. You know, so you would have to do like a half lot on something like this to run like that nasty of a stop loss. But the risk reward is still like 4.5 to 1, so it's still a juicy trade. Not one that I'll be throwing on right this second, because I don't expect these pot stocks to stay strong when everything else looks so weak. I think everything's just looking for like new lows. CCJ, Chemical getting rejected, 200 exponential and simple. Looks okay for now. Hard buy signal, a couple green histograms. Looks like it's holding 23. If it holds this level, it looks okay and probably tries to push back up once again. Really needs to get back on top of 200 exponential and simple. URA looks much worse. You know, lost to 200 exponential and simple. They're rolling over. Lost key Fibonacci levels. You know, probably does hit our next target, 1750, with lower targets in mind. UEC, again, getting rejected, 200 exponential and simple. Still holding the bottom of this support for now, which is okay. But arguably, should we be paying more attention to something like this at this point in time? Probably, because this looks like a parabolic, like rounding pattern is taking place right now. So I would more expect something like this to hold, which it's not. It's a couple dollars lower. It doesn't make much sense. But I wouldn't want this to break and then you're like, oh, that's it, it's bearish, and then it holds at this support. So somewhere around this area probably is a short-term bounce, but I don't know. These uranium stocks look tired. And then UROY already hit the targets at downside. Still looks very weak. Much, much weaker than everything else. I don't know, though. I wonder if these uranium stocks are ready to pop off. Like quick little like 25 and 35%. We'll see what happens with the rest of energy. I don't know. I think the uranium narrative is still strong long term, but short term, I think it's played out. A lot of people FOMO'd in over the last couple of years, and a lot of them, you know, depending when you got in, a lot of people are probably not in profit on those uranium trades right now. It's like the dog of the investing universe already, so definitely not what you want to see. But yeah, that's it. We got them all done. We did it. We made it to the end. What's up, Yoda? Or as Elon put it, Sailor Moon, except no space exploration for him. That's funny. Yeah, and keep in mind, I only hate on people like Michael Saylor, you know, because he's a charlatan who was, you know, not technically found guilty of fraud by the IRS or by the SEC, but you know, he pled out and paid millions and millions of dollars, you know, for fraud, you know, lying about earnings and basically just fudging the books of his publicly traded company, MicroStrategy. You might have heard of it. in the 2000 dot-com bubble burst, and then it lost 99.9% of its value. So it's not like unwarranted reasons that I'm mean to Michael Saylor. It's because he's a scammy piece of shit. But that being said, same with Cathie Wood too. I try not to hate on Cathie Wood too bad, but it was very clear what was taking place and how many people have been hurt by what took place. And again, if you do any background into Cathie Wood and start looking at where she got her funding for her ARC funds and some of her mentors and some of her affiliates and business partners, you will quickly notice that she has some pretty shady ties as well. So that's why I bust these people's chops, to kind of warn people that they're trash human beings, or at least have made some pretty terrible decisions in the past knowingly at the cost of other people, or where they gathered their capital from was probably a super shady place. But that being said, I'm going to go ahead and wrap it up there. Thanks for tuning in for that Wednesday night midweek market update. Does look like we're expecting further downside. We're seeing new lows on a lot of the stronger stocks, new lows on a lot of the weaker stocks, and in many cases anywhere from 0 to 5 days without incident. Not enough for me. Markets don't bottom 5 days after their lows. At least people don't figure it out then. So I do not think it's likely. I think it's likely we get some more serious downside pressure. So going to be real cautious. Obviously, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Make sure you are protecting your principal, your capital, and obviously paying attention to key things in the markets, but always respecting the key principles of investing and trading. We want to trade with the trend for highest probability of success. We want to measure out risk-reward ratios based not only on, what looks good on paper, but what looks good on the chart too, and likely moves, and make sure that we have a favorable risk-reward ratio, favorable probability of success. We always want to make sure that we are focusing on position sizing so that we don't blow out our account going all in on one big move, or we don't miss out on massive gains by taking too small of positions. So that being said, when it's all said and done, we have the highest probability of success in these markets. And like always, we never want to stop learning, always want to continue educating ourselves, sharpening up our tools. Once you've learned everything, you can go back and relearn some stuff again, and you'll probably learn stuff you didn't pick up the first time. So, but that's it for tonight. Going to go ahead and wrap it up there. Appreciate everybody tuning in today. All the comments, likes, shares, subscribes, all that good stuff. Definitely appreciate all the positivity in the community, especially at times like this. And I know it can get a little frustrating logging in, looking at your accounts, or maybe you just don't want to log in and look at all, or maybe you don't want to put in the work, and it makes you mad or sad or whatever because you're at a loss, or you just don't care because market's going to sell off for the next year. But I'm telling you, the bear markets are the best time to educate yourself, to invest in yourself, because you can take that same money or that same time or whatever resource is most valuable to you, and you can use that to fine tune your own skills. And then when we do get the next bull market, you will be fully equipped to take advantage of it. And the education is made in the bear market, the money is made in the bull market. So that being said, I'm gonna go ahead and wrap it up there. Appreciate you guys. Everybody have a great night. It is 9:40 p.m. Eastern Standard Time on Wednesday, May 18th, 2022. And that's it for tonight. Crypto Trend Trader. And I'm out of here. Everybody have a good night, and I'll catch you later. Peace. Take it easy, J Hoff. Good to see you. Appreciate the appreciation.